Good morning, everyone. This is Millie Hong, Head of Events at ASIFMA. Thank you for joining us at this virtual event, IBOR Transition in Asia Pacific. Let me introduce our host today, Mr. Mark Austin, CEO of ASIFMA. Mark, over to you, please.
Thank you very much, Millie. We're very pleased to have you here today to talk about in our webinar, the IBOR transition in Asia Pacific. This is a topic that by the day is getting more and more crucial because firms need to be ready for this transition in the Asia region. And this will be really the focus of most of what we're talking about today. We have well over 900 people signed up for this. We have well over 300 that have already come into this webinar. And I really want to thank, before we start, the 8 associations that are endorsing this webinar that are on the screen in front of you. But they're the Association of Corporate Treasurers, the Asia Pacific Loan Market Association, the Financial Markets Association Malaysia, the Hong Kong Association of Corporate Treasurers, the International Capital Market Association, the Korea Financial Investment Association, the Treasury Markets Association, and Women in Finance Asia. And through these endorsers, that's where we've been able to get to all of you so that you can join this event with us today. I'd like to take a bit of just to cover the agenda very quickly. Before introducing our keynote, just to remind you that we'll also have a regional update from Rebecca Weinreich here at ASIFMA. And then we'll be following these from the industry associations, some of which are endorsing today, APLMA, Andrew Ferguson on loans, Jing Gu from ISDA on the derivatives part, and Mushtaq Kapezi from ICMA on bonds. And then finally, we'll have an update from Bloomberg. And if you, for today's event, if you want to ask questions, please do so in the box below you. And you'll see that little chat box. You can ask questions anytime through this, and we'll do our best to facilitate those to the speaker. Just one reminder, please keep the questions to IBOR transition. That's what we're really focused on today. Please don't go into other topics not related to IBOR transition. So without any further ado, I want to introduce somebody who needs no introduction to any of you, Arthur Yuan, who's Deputy Chief Executive for the HKMA, the Hong Kong Monetary Authority. He's also the lead on the FSB report that was recently delivered to the G20 finance ministers and central bank governors on the remaining challenges to benchmark transition. So Mr. Yuan will effectively set the scene of where we are in transition for IBOR globally and also specific to the region. So over to you, Arthur. Thank you.
Yeah, thank you very much, Mark, for the introduction. Are you hearing me okay?
Yes, we hear you loud and clear.
That's good. That's good. Thank you very much. And good morning, everyone, to this event. And thank you to ASIFMA for asking me to attend this event. And I certainly, I hope everyone is staying safe and healthy in these kind of environment. The topic of this event is actually IBOR transition in Asia Pacific. I hope that everyone attending this event has had a chance to look at the report published by the Financial Stability Board and Basel Committee on the 9th of July about benchmark transition. The title of the report is Supervisory Issues Associated with Benchmark Transition. That would be the topic of the core issues that I'm going to talk about in this session. So although this session is called a keynote, but is not really a keynote per se, because I'm trying to use that report as an introduction to this event and to try to get everyone even more sort of attuned to this particular issue of IBOR transition and the importance of that, as well as to take you through some of the findings that we have discovered in the context of that report, so that everyone would have a better idea of what are the issues that we have to grapple with going forward. Next slide, please. I'm sure everyone is already familiar with why we are engaging upon this journey of benchmark transition. It all came from the global financial crisis. After the crisis, we have seen a decline in the liquidity of the unsecured money markets. We have also seen a number of cases involving attempted or successful manipulation of the benchmark rates markets. And these incidents have resulted in a general call internationally about ways to strengthen the benchmarks arrangements and to promote the use of alternative reference rates. And in the case of LIBOR, actually, the UK authorities have already announced that they are going to stop compelling banks to participate in LIBOR panels after end 2021. And that would mean that after end 2021, we can assume that LIBOR would no longer be reported. And against this setting, the Saudi Arabian G20 presidency this year has made benchmark transition a key priority of the work of the G20. And the G20 actually asked the FSB, I think late last year, to do a stock take on this very important topic. The idea of doing a stock take is really twofold. First is to improve our collective understanding of the progress of LIBOR transition so far. And secondly, is to raise awareness of the importance of this particular topic, and particularly the importance of a timely transition before end of 2021. And since then, FSB put together a drafting team together with the Basel Committee. And I am honored to be leading that exercise. Although we have completed the report, as I would describe later on in the presentation, we are continuing with this line of work. And so I'm continuing to lead this drafting team to take this matter forward. So last December, we issued a questionnaire to a number of jurisdictions, including FSB jurisdictions, Basel Committee jurisdictions, and the Financial Stability Board Regional Consultative Committee members, Regional Consultative Group members, for their inputs into both quantitative and qualitative assessment of the issues, of the various progress, challenges, issues that we need to tackle with going forward. And finally, that culminated in a report that was published on the 9th of July. I hope everyone would have a chance to take a look at that, because we've tried to make the report as informative as possible. And it does highlight some of the things that potentially we may need to focus our minds on. That if you look at it from the other perspective, is perhaps there are issues that internationally we are not making adequate progress, and therefore we should really focus our minds on going forward in the remaining time before end 2021. So when you have a time, when you have a chance, do get hold of a copy of the report and take a look at it. Next slide, please. Before I actually go into the findings of the exercise, let me start off by a note of caution on how do we actually look at the responses submitted and the data presented in the report. First, we actually sent out the questionnaire to 96 jurisdictions, but we received 57 responses. Not bad, but still, people reading the report have to bear in mind that there are a number of jurisdictions which have not actually submitted responses to us. In Asia Pacific, we sent the questionnaire out to 18 jurisdictions. 13 of those came back to us. A deeper issue is actually when we look at the responses provided by the respondents, the contents, the degree of, the level of details of the responses actually vary quite substantially, in particular when it comes to quantitative side of the thing. And therefore, it makes a very comprehensive assessment and analysis, in particular quantitative analysis, is actually quite hard. We've tried our best to do it, so we have presented what we have been able to do in the report, which I would take the audience through in the next few slides. But do bear in mind that it's actually a very limited, it's not very, but it's kind of a limited scopes of analysis based on whatever that have been submitted to us. Secondly, is data quality. We have actually worked very hard during the few months we're working on it, on the numbers. trying to work out with different authorities in terms of numbers that they have submitted. Some of the information are submitted on different bases, so we have to sort of clean out the data. The data submitted were actually of different granularity, and therefore, again, we have tried very hard to do the number crunching, but there are certain limitations that we have to watch out for. Next slide, please. So let me go into the findings. The first major findings, which would not surprise everyone or anyone, that most FSP jurisdictions said that there will be significant negative impact on both financial institutions and non-financial institutions if we do not adequately prepare for the LIBOR transition process. Most FSP jurisdictions also have put in place a strategy for the transition. Now, I'm focusing on FSP jurisdictions. So in terms of FSP jurisdictions, we're generally fine, and they do understand the potential negative impact that this process is going to have on financial institutions, non-financial institutions, if we do not prepare for it adequately. By contrast, when we look at non-FSP jurisdictions, only half of those jurisdictions share those kind of concerns about the negative impact, or they have a strategy in place. So there is a very distinct feeling, distinct differences in the assessment and feeling that we have on FSP jurisdictions and non-FSP jurisdictions. Now, turning our attention to Asia Pacific, actually 54%, about half of the responded jurisdictions indicated that they do foresee significant negative impact arising from the LIBOR transition process. The vast majority of them, 92%, have a transition strategy in place. And so in terms of the Asia Pacific region, I have to say that as a sample, that it's better than the rest together in terms of the awareness of this issue, and also in terms of the strategy that they put in place. Now, having said that, overall speaking, we have to always bear in mind that we only have 17 months left in this process. It is a very tight timeline. If you look at the issues that we identified in the report that needs to be dealt with, which again will be covered later on in the presentation. And the current pandemic situation is making it even more complicated because depending on which jurisdictions you're in, if you're facing still an ongoing transmission of the disease, it might actually make it difficult for you to engage clients for negotiating fallback languages to be included in the contracts or legacy contracts that you need to deal with. So it's actually very crucial, I would just say that upfront, I will come back to this message later on. It's very crucial for market participants to start moving away from planning for this transition process into actual execution of the migration process in order to ensure that we can deal with the whole host of issues that we need to deal with in the remaining 17 months of this journey. Next slide, please. So the first finding is about the different jurisdictions' assessment of the situation and whether they have started this journey. The second finding relates to monitoring efforts. In this slide, I've plotted whether the responded jurisdictions are collecting quantitative data on LIBOR exposures, whether they're asking financial institutions to provide transition plans. You can see that actually among the FSP or LIBOR jurisdictions is fine. Among FSP jurisdictions, the majority of them are already collecting quantitative data on LIBOR exposures or asking for transition plans from financial institutions. But if you look at non-LIBOR, non-FSP jurisdictions, the yellow bubble in this, less than half of those non-FSP jurisdictions, actually collecting quantitative data on LIBOR exposures of financial institutions. Now, the numbers below that bubble is the Asia Pacific number. You see that generally speaking, we're better than the rest, but still only 60% of the Asia Pacific respondents actually collecting data or quantitative data on LIBOR exposures. Now, the problem is if you don't collect LIBOR exposures statistics, it's actually quite hard to formulate a view on how significant issues you're dealing with come end 2021. And if there is a significant sort of risk, you won't be able to deal with it to start with. So this is something that we need to watch out for. But at the same time, we also notice that all responded Asia Pacific jurisdictions have some form of monitoring. Either they collect data or they ask for the transition plan. So the 60% and 80% are not completely overlapping in a sense. So most jurisdictions in Asia Pacific region are already looking at this issue one way or the other. It's just that we will still urge jurisdictions to collect more data, quantitative data on LIBOR exposures, and to look at transition plans in a more holistic manner. The survey actually also showed, I didn't show it on the slides, but the survey actually showed that both LIBOR and non-LIBOR jurisdictions have better coverage on financial institutions than non-financial institutions. I think some jurisdictions are doing that because they think that non-FIs, non-financial institutions, are little exposed to the transition risk. But we don't really have enough empirical evidence to support that sort of assertion, because those jurisdictions, some of those jurisdictions that are saying that, are at the same time not even collecting LIBOR exposure quantitative data. And if you're not collecting data, how do you know that you can actually make that sort of assertion? So I would take that sort of assertion with some degree of suspicion. Next slide, please. We have tried to come up, despite all the limitations on quantitative aspects of it, we have tried to come up with a quantitative analysis of how much are we talking about here. You can see that from this charts that as expected, in the LIBOR jurisdictions, the financial institutions are actually quite exposed on both the asset and liability side. For non-LIBOR FSB jurisdictions, the exposures to US dollar LIBOR is also significant on both asset and liability side. But for non-FSB jurisdictions, the exposures are relatively more muted compared with the LIBOR and non-LIBOR FSB jurisdictions. But once again, as I've mentioned, some of these jurisdictions are not even collecting quantitative data. So again, the very muted sort of exposures needs to be taken with some degree of suspicion there. But in Asia Pacific region, you can see the LIBOR exposures are mainly concentrated in US dollar and not in other currencies. Another interesting observations is we actually ask how much of those contracts that are referencing LIBOR are actually at risk. At risk meaning that they would mature after end 2021. And we came up to the, if you look at graph 7 of the report, we do have some a slide there showing the distribution of those expiration of contracts. And you can see that roughly about 40 to 50% of the SSN derivative exposures are expected to mature after 2021. A similar pattern is actually observed in Asia Pacific. So we don't, you can safely assume that about half of the asset and derivative exposures would be what we call at-risk contracts that would need a robust fallback language to be included. But we actually try to ask, do jurisdictions know how much of those contracts already have a robust fallback language incorporated, but the jurisdictions can't provide those kind of information to us. So maybe that is something that different jurisdictions need to start looking at more closely. Next slide, please. In terms of the respondents' awareness and readiness of the financial institutions, we found that financial institutions and LIBOR jurisdictions have shown better progress, which is again understandable. If you look at this chart, the bars, you can see the Asia Pacific region, generally speaking, have more yellow or blue in that is actually better than pink. And so I would say the Asia Pacific region are generally speaking in making more progress, are generally speaking making better progress than the rest of the pack in the transition process. Financial institutions also indicated in those in the process that the clients had slower transition progress compared to themselves, which is again understandable because financial institutions tends to pay more attention to these kind of things. But because of this, financial institutions in most FSP jurisdictions have already started to work with the clients to prepare for the transition, encouraging clients to adopt fallback languages and to make more, perhaps more importantly, to start making necessary changes to the internal processes as well as the IT systems so that they could actually adopt alternative rates or fallback language in their daily operations. Whereas we noticed that actually in non-FSP jurisdictions, this process has, in some jurisdictions has only just started, in other jurisdictions is still pending. So again, in terms of the awareness, non-financial institutions or clients of financial institutions is a potential sort of weak link that we need to look at. Next slide, please. In the survey, we have actually asked about potential risk coming out from transition if we don't get prepared for it. And also we asked for the inputs on transition challenges. In the interest of time, I wouldn't go into too much details on these slides, but in terms of things like operational risk, you would have like the need for updating systems, updating processes that are currently referencing LIBOR. And if you don't update those systems, it's highly likely that you won't be able to do any contracts in the end after end 2021. So there are certain operational risks involved. Reliance on third-party service providers is another operational risk because they might not be as attuned to this particular issue as the financial institutions themselves, as I've already mentioned earlier. There are also legal risks, there are prudential risks. I won't go into too much details there, but hedging is an interesting concept because for hedged positions, different parts of a hedged positions could be transiting to alternative reference rates at a different pace. Now, if that happens, then it could actually frustrate the effectiveness of the hedged position. And so this is a risk that financial institutions needs to also watch out for. Accounting and taxation, of course, is also issues that different jurisdictions are trying to grapple with. Now, in terms of transition challenges, we have listed there a number of things like the main challenge that is mentioned by the respondents are actually the difficulties of agreeing to contract amendments with clients. Lack of term rates for the new risk-free rates, the alternative reference rates, lack of liquidity in the market for the new rates, etc. But if you look at the numbers for the Asia Pacific region, interesting enough, the bar about lack of awareness, we got 23.1% of the respondents, which is actually quite a bit higher than the rest of the pack. And so I think generally speaking, Asia Pacific central banks and supervisors are more concerned about the lack of awareness in the region about LIBOR transitions that might actually be making the progress slower than we would like to see happening. This next slide, please. Now turning, that is the transition risk as seen by them, but there are also responses by those central banks and supervisors in terms of supervisory actions that they're taking. In terms of, again, LIBOR jurisdictions here, as expected, doing better than non-LIBOR jurisdictions. They are resorting to different types of engagement with financial institutions in order to enhance their awareness and also to start the process going. They have sent out DSEO letters to enhance their awareness and preparedness. They are meeting with the boards. They're collecting data and transition plans. They would also encourage banks to adopt internal targets and deadlines for transition. And then finally, they would use the supervisory process, both desktop reviews and on-site examinations, to review the progress of transition. And if there should be less than satisfactory progress, those FSB jurisdictions all told us that they already have a suite of supervisory tools available to speed up the transition process. They could actually ask to meet with the boards. They could issue non-binding best practices to the industry to follow. If they think that more intensive supervisory actions are needed, then they could actually do other things, like even on things like capital add-ons, and also restricting certain sort of product offerings. Now, those are very extreme sort of powers, but the important point there is FSB jurisdictions generally said that they already have those powers in place, and they are ready to use those powers if LIBOR transition or IBOR transitions turns out to be not satisfactory in their respective jurisdictions. We also asked supervisors to let us know what they see as the major challenges that they're facing. Some jurisdictions told us that they have limited resources. I mean, the supervisors have limited resources and limited capacity to deal with this particular issue. Some also told us that their engagement with financial institutions have only just started, and they're seeing the compressed timeline by the current pandemic situation as a major challenge as well. For some financial institutions, some jurisdictions told us that it would be, for smaller ones, smaller financial institutions and local financial institutions, some jurisdictions said that it's actually quite hard for them to start this journey on transition because of the intensive resources that is required in dealing with this issue. And on this one, I think it's very important, and I'm grateful for ASIFMA for preparing and developing an IBOR transition guide. I think that would be extremely helpful for financial institutions in the region to embark upon this transition journey. Some other respondents told us that, once again, that they are concerned about non-regulated institutions not really progressing at the same pace as the financial institutions, and the supervisors don't have any handle on those non-regulated entities. Things like external service providers, financial institutions have to work on those service providers themselves, and the supervisors and central banks really have very little handle on those external service providers in coming along and progress at the same pace. Cross-border, another challenge that was always mentioned is cross-border cooperations. Different parts of this and international banking groups working in different jurisdictions, facing different transition timeline or pacing, could make it very difficult for the financial institutions and for the banking supervisors in the host jurisdictions as well. And so that highlights the importance of home-host coordination on the transition process. First, to make sure that we're progressing at the same time, and secondly, to make life less difficult for institutions that have footprints in different jurisdictions. In Asia Pacific, this is particularly so, I think, an issue that we need to deal with, because we do have a lot of foreign bank branches operating in Asia Pacific, and we have to work with the home supervisors on that. Next slide, please. So, having looked at those findings, the report actually came up with a set of recommendations on what needs to be done going forward, that we hope different jurisdictions will actually start thinking of along these lines. We broadly classified the recommendations into 3 categories. Category 1 is about identification of risks and challenges. So we want jurisdictions to start really enhancing awareness, start tracking the risk, start tracking positions, and start tracking statistics if possible. The second group of recommendations is about facilitation. How do we facilitate LIBOR transitions? We need to communicate better with the industry as well as among different jurisdictions. We need to communicate better on the timing of proposed changes in market convention. And recently, for those of you who are actually in Hong Kong, you would have seen that the HMA issued a circular on the 10th of July to all authorized institutions in Hong Kong, setting out our latest views on LIBOR transitions. And we actually asked the institutions operating in Hong Kong to come up with what we call transition milestones. So that is an example of the efforts that we want to communicate in clear terms with the industry on what we expect them to do in terms of the migration process. By setting these milestones, of course, these milestones are not really, we have to rely on the banks to actually work on it, but we set the timeline as an expectation for banks to follow. By a certain date, if they are issuing new contracts with LIBOR as a reference rate, they have to include robust fallback provisions in it. Things like that would be extremely helpful as a facilitation measure to the industry, so that everyone would have something to look at or some timeline to look at, common timeline to look at going forward. We also would urge jurisdictions to conduct desktop reviews and on-site examinations on the progress of transition, and to the extent that they see the need for speeding up, they have to stand ready to use the supervisory powers to do so. Finally, the third group of recommendations about coordination to foster LIBOR transitions. Coordination could mean coordination within a particular market. So industry-wide coordination is not just about banks, but also other financial institutions, as well as clients of financial institutions. It could also mean international coordination. So we have to continue to exchange views through international forums, and also to work with national bodies to identify potentially we were told that there are contracts that are very difficult to migrate because you need to get a lot of parties to actually sign on to it before you can migrate. And for those kind of what we call tough legacy contracts, we're already seeing some jurisdiction coming out to say that they might actually have to go down the route of legislative solutions. By legislating for the change, adoption of a fallback language, it actually helped address the issue of having to find, let's say, 100 different parties to sign on to a change to the contract. So that is another coordination issues that we need to deal with. Next slide, please. So going forward, actually, the FSB and BCBS joint efforts on this, as I've mentioned at the beginning of the presentation, will continue. We have published this report on the 9th of July, but we are going to come up with a set of simplified metrics and also a list of qualitative questions that we're going to ask. And with that, we are going to do another round of progress checking in early 2021 to see where we stand on the progress on this journey. And if we don't see adequate progress, then we may have to think about other recommendations at that time to be suggested to the Financial Stability Board and the Basel Committee to take. Before I finish, I'll just leave you with this acronym of SMART, which I think it's an easy way for us to remember what we need to do. I do think that although as I'm making the presentation, you would have seen that in Asia Pacific, we're generally speaking perhaps a bit more aware and more sort of progressing in terms of this particular project than the rest of the world. But still, we think that you have to start action now. and to speed up the process now. We only have 17 months left. And you have to bear in mind that the issues, some of the issues that I've mentioned in the previous slides are actually quite hard to deal with. Now think about fallback language. For derivative world, it's actually maybe easier because we have Easter coming over with the fallback language arrangements. And once that is adopted, then it's actually much easier for us to deal with the derivative side of things. But when it comes to loan contracts, it's actually quite difficult to have standardized fallback language. I'm sure there are attempts currently being put into this particular issue. And I'm sure this issue will also be discussed later on in the panel. But having only 17 months to work on those, and given the numbers that we have seen and the amount of contracts that are expiring after end of 2021 on both the cash side and the derivative side, is actually a very compressed timeline. So start now and speed up now. In terms of starting, what do you start? Actually start off with monitoring exposures, allocate resources, monitor whether adequate resources have been put in, and make sure that financial institutions and their clients, as well as service providers, are actually making meaningful progress in this transition process. Regularly assess the risk and the challenges that you're facing and respond to those. And if you need to ask for additional guidance from the central banks and the supervisors or the national committees, do so. And finally, I hope that we would have a smooth transition. And I do hope that by early 2021, when we do the follow-up stock take and progress check, we will see a much better picture. So thank you very much, Mark. I would stop here, and I would be happy to take questions.
Great, thank you very much, Arthur. Really highly appreciated for a very comprehensive and detailed overview from the FSB and Basel Committee on where the transition lies currently, and the challenges that are still faced, including in this region. There's been a number of questions, but giving time, I'm going to wrap a few into one question, and it's really around banks or participants' readiness. You know, we've seen, you know, there is a view that whether participants are ready operationally to issue products referencing the RFRs. You know, there's a view that the international banks are better prepared than, say, the local banks or the corporates in this region or elsewhere. I guess, yeah, almost on what you were finishing on, I mean, is there one piece of advice you can give corporates and about their readiness for IBOR transition?
Well, I think my advice is to start action soon. But below that, I do have a strong attachment to setting timelines for yourself. As I've mentioned, on 10th of July, HMA issued a circular to banks asking them to come up with what we call transition milestones. We do attach a lot of importance to firms having those kind of timelines to work against. When I say 17 months, it's actually a very elusive concept. If you just think about the 17 months, it's not helping you. You have to start thinking about how you allocate that remaining 17 months into action points. And the first thing that I think needs to be done is to think about these kind of transition milestones. And we have different transition milestones for different types of issues that we're dealing with. We're basically grappling with two separate issues here. First, as you've mentioned, issuing new contracts. When we issue new contracts, there has to be a point in time when we start migrating to new reference rates, the alternative reference rates, rather than continuing to aggravate or perpetuate the issue of issuing new contracts on LIBOR, for example, or other IBORs. So new contracts is an issue that needs a milestone. Legacy contract is perhaps the more imminent issue of how do you build in fallback language. As I've said, for derivative contracts, it's easier because Easter is working on the fallback language for the master agreement. But for cash contracts, it's actually very complicated. And for liability side, for capital instruments that are referencing LIBOR, how do you deal with it? And without those kind of milestones, it's actually quite hard for us to think about those kind of things against a specific sort of timeline. So 17 months is only the remaining time. Do allocate that 17 months into actual milestones that you can work against and measure yourself against. I think both industry and the central bank supervisors in the region should work along those kind of a mindset.
Great. Thank you very much, Arthur, for that question. And I think that will segue very well into our next speaker. But I really wanted to thank you today for taking the time and really setting the scene. I mean, there's a lot of interest in this. We've had well over 760 participants have been on this webinar, which I think is a record for us at ASIFMA. I know we've had a few compatibility problems on the web browser. Just to let you know, the video will be available afterwards as well as the slides. So if you haven't had those compatibility issues, just be able to get that off our website or from our Millie and her team. There are a few other questions that we haven't had time to answer, including around the US dollars, use in the local market, reference rates, and also around the fallbacks and the familiarity with those in the region. I believe those will be picked up by other speakers later on, including ISDA and APM-LMA on the derivatives and loan side. So without any further ado, I think it segues very well into Rebecca on our side, Rebecca Weinrock, who's our Executive Director and Head of Fixed Income at ASIFMA. She will cover the guide that Arthur also referenced earlier that we have put out collectively with a number of other associations on getting yourself ready for the for LIBOR transition within this region. So over to you, Rebecca.
Thank you, Mark. As Arthur just emphasized, it's time to turn from transition planning to execution to meet the tight timeline by the end of 2021. I want to take this opportunity to discuss with you how we at ASIFMA will support you in your readiness. As Arthur and Mark just referenced, ASIFMA has recently published an IBOR transition guide for Asia, along with ISDA, ICMA, and APLMA, and with support from our member firms, Deloitte and Morgan Lewis. This guide provides an overview of the key implementation issues to be considered by financial institutions in preparing for the transition from LIBOR and all its tenors and currencies to alternative risk-free reference rates by the end of 2021. Specifically, I want to highlight that the guide includes a practical implementation checklist, which you may use as a reference, as well as key questions to consider in your firm's LIBOR transition. These questions suggest that your firms should be thinking about LIBOR and the differences between LIBOR alternative reference rates, legal and contractual implications of the transition, how the change in rates impacts operations and technology, what internal training and client communications are required, and whether your firm has any conduct risk. For those of you who are beginning executing on your IBOR readiness program, this guide is a great place to make sure your survey and your plan is comprehensive. It is also a terrific tool for you to share with your clients as you begin your dialogue with them around rate transitions. This guide can be accessed by scanning the QR code on the slide, and it is also available on ASIFMA as well as the other industry association websites. In addition to co-publishing this guide, ASIFMA is in the process of surveying members regarding their concerns around external frictions throughout the region that may pose a challenge for IBOR readiness. In any major transition, there are always unknown collateral consequences. And we believe ASIFMA can facilitate the industry in identifying these challenges and ensuring that they're incorporated into our IBOR advocacy planning. So even if you're not an ASIFMA member and you've identified an issue that you believe would be better handled at an industry-wide level, please share it with us, and we will ensure that it is appropriately raised. One major concern in Asia that has already been flagged is transition education in emerging Asian markets. And specifically, we were hearing from our members, and Arthur just reaffirmed, that Asian emerging markets are not adequately engaged in IBOR transition preparations. This webinar, for example, while widely attended, has just a handful of attendees from outside Singapore and Hong Kong. To close this gap, we will be working with members and local trade associations to conduct specifically tailored webinars for India, Malaysia, Indonesia, Thailand, the Philippines, and Vietnam. We will also do a program that's designed for Singapore and a program in Mandarin. If you think that there are any gaps in these programs, please reach out to us and let us know. We're happy to fill them. In promoting these programs, we will look to partner with all of you who are listening to this webcast with regional responsibilities. When these programs are announced, we ask that you push them out to your local operations in these countries and share them with your clients there. The more FIs that have the opportunity to participate in country-targeted education, the easier it will be for your organization to achieve IBOR readiness. Now, to better understand product-specific approaches to IBOR transition, we'll hear from each of the product specialists from the industry associations, APLMA, ISDA, and ICMA. As a reminder, while they are speaking, please do feel free to send in questions to the Q&A chat. And now I'm going to introduce Andrew Ferguson, Chief Executive Officer of APLMA, who will share with us the latest updates on APAC loan markets. Andrew, over to you, please.
Thank you, Rebecca, and thank you to ASIFMA for organizing the event today and for giving APLMA an opportunity to give you an update on the syndicated loan market in Asia Pacific. As you can see, I'm not in the office and I haven't yet got an APLMA backboard for my living room, and I'm not sure my wife would be happy about it. One of the recurrent themes over the last few years has been that the loan markets have been something of a laggard relative to other product groups, particularly swaps and derivatives, in terms of the LIBOR transition. One of the reasons for this is that loan contracts or cash contracts are especially difficult to amend or to transition. However, I do think that the pace of change has changed dramatically in the last 6 months, particularly in the UK and the US, a bit slower here in Asia Pacific. But let me give you an insight into a few of the things that have been bothering us. But first of all, let's just look at the size of the problem. If I could have the next slide, please. As you can see from these numbers, which have been finally provided by Bloomberg, there was a whopping 470 billion of US denominated loans outstanding in APAC as at the end of June 2020. And as you can see from the next slide, please. Okay, a large part of that 470 billion matures after 2021. That's to say 22, 23, 24. The numbers are huge. Next slide, please. Arguably, the biggest problem for the loan markets is, or has been, having to adopt overnight risk-free rates for the purposes of accruing and settling interest on loans. For most people in the syndicated loan market, this is a complete anathema and goes against everything we've been doing for the last 50 years. So this is a massive change. And right now we're in the middle of a huge debate as to how we actually use those RFRs and what calculation methodology we should use. The Bank of England Working Group seems to have settled on using compounded averages, as has ISDA. I'm sure Jing will tell us that. For anyone that doesn't understand what that means, and very rapidly, a compounded average of a series of RFRs is a single percentage rate per annum, which reflects the cumulative effect of individual daily readings of the RFR over a defined period of time, and can then be applied to the relevant principal sum outstanding at the end of the relevant period. It's important to note this only works if the principal amount hasn't changed. And as we all know in the loan world, particularly in the revolvers and prepayments, mandatory prepayments, that isn't the case. If you need more information on the rather complicated mathematical formula required for a compounded average, You can find it in the Bank of England, the FSB guide, or indeed the ARC guide. The important point here is that a lot of banks and borrower systems are not set up to calculate and process interest based on historic overnight rates. Now, this is mainly anecdotal evidence, but my sense is that a lot of banks in Asia Pacific are actually struggling to set up the systems and processes for compounded average calculations, and if they're actually working on it at all. And then to come up with the settlement and accounting processes within the time frame which Arthur's just been talking about, 17 months. But what seems to me to be slightly ironic is that while the Bank of England believes that compounded average rates are the best way forward, and have also recently announced a SONIA compounded index to be launched next month in August, our friends in the ARC in the US have launched just recently on the 30th of June, a new set of recommendations for the syndicated loan world, which focus on daily simple SOFR on the basis that the loan world needs to be able to accrue and account for interest on a daily basis. That's the basis of our business. And it's noteworthy that in the ARC recommended replacement waterfall, the first option is in fact term SOFR, then simple SOFR, and then perhaps as an option, daily compounded SOFR, but no mention of compounded averages. So in other words, we do not have consensus on what the calculation methodology ought to be, nor on the related conventions that will go around it and will need to be adjusted. Now, the way I see this, it's a massive roadblock to transition. If I could have the next slide, please. As you know, meanwhile, I should say, APLMA, LMA, in fact, LSTA, are all still committed to developing IOSCO compliant forward-looking term rates derived from RFRs, or indeed from other sources acceptable to the regulators. All three of the trade associations I just mentioned would like to be able to use forward-looking term rates in the syndicated loan markets, if at all possible. And it was therefore comforting that Refinitiv launched last week Refinitiv Terms SONIA, making it the second benchmark administrator to come up with a methodology to create forward-looking term rates. Next slide, please. Thank you. We then come to the question of credit adjustments, or what the ARC calls benchmark replacement adjustments. As we all know, risk-free rates tend to be lower than LIBOR rates because LIBOR contains some element of credit risk and duration risk. This Bank of England slide up there compares sterling LIBOR with overnight interest rate swaps and shows that difference rather well. As I'm sure Jing at ISDA is going to tell us shortly, ISDA has already consulted its membership on the subject and has already agreed a methodology to address the economic transfer issue. Basically, ISDA members have agreed to calculate a one-time static credit adjustment calculated as an average of the difference between LIBOR and the relevant RFR over a 5-year pre-cessation period. Jing, I'm sure you'll correct me on that later. This approach is also being recommended by the ARC, but in general, this static approach isn't, I'm afraid, much liked in the loan markets. And our sister association, the LMA, has already made representation to the Bank of England, suggesting a more dynamic credit adjustment methodology, perhaps derived from forward Forex or futures markets. But that would be, we hopefully would be more appropriate for the loan markets. So yet another issue to be resolved. Next slide, please. Then we will have to work out the practicalities of observation shifts and lag periods. This is again something of an anathema in the loan markets. And can you imagine the absurdity of using a 5-day lag period for a 2-day interest period? It can and will happen. The FRN market has, of course, already been using 5-day lag periods, and this has been replicated in some of the RFR pilot loan deals. But quite frankly, perhaps to an old-timer like me, it feels strange and unnatural to be using observation periods and lag periods in the loan markets. So perhaps the LSTA simple SOFR approach might have some merit after all. Next slide, please. We then get to the fallbacks when published screen rates, be it SOFR or SONIA or whatever, is not available. And the hardwired replacement rate waterfall doesn't actually work. Should we simply fall back to some kind of bank rate? That's what actually happened in the BAT deal that I'll mention in a moment. Or should it fall back to some other similar maturity government bond? Or should we preserve that rather not liked concept of lender cost of funds? As yet, there's no market consensus on that, and consensus must be reached very soon if all the legacy contracts are to be amended in time before the end of 2021. Next slide, please. In the syndicated loan markets, RFRs will also bring additional responsibilities for the agent bank, and this hasn't actually been much discussed in Asia. Notably in respect of when the published screen rate is not available. Agents typically don't like having to make decisions of a commercial nature. They like to work mechanically and take instructions from the lenders. What stands out in the ARC's 30th of June recommendations is that the agent is going to be taking a very active role in the LIBOR transition. And for example, the agent is going to be very much involved in making conforming changes to documentation. The agents in APAC, as far as I know, have not been consulted on any of this, and certainly aren't going to be happy having to manually calculate a compounded average for an odd period of days when there's no published rate. So the question's still out there: will the loan markets in Asia be ready in time? And you'll note I haven't mentioned the word COVID yet, nor will I. Next slide. There have been some pilot transactions which have been helpful. I might mention National Express and the British American Tobacco, the BAT deal. On the BAT transaction, with the help of a friendly law firm, we're just about to put out a video on the key structural issues, which you might like to track later. And then, of course, we had the Capital Land deal in Singapore, but there haven't been many pilot transactions. And as the old saying goes, one swallow doesn't make a summer. I'm told by my lawyer friends that they haven't received many, if any, instructions to document RFR-based loans. Most indeed said none at all. So there aren't even many RFR deals coming down the pipe. Which brings us to the legacy transactions, the hundreds of new deals. I'm sorry, could I have the next slide, please? It brings us to the legacy transactions, the hundreds of new deals that we read about every day are still being written and priced off dollar LIBOR. How are we going to transition those legacy deals into the brave new world of RFRs when each and every one of them will have to be individually amended or redocumented or refinanced? And remember, work can only start on that when consensus is reached on calculation methodology and the other conventions specific to the loan market. In that connection, I was interested to hear from a senior banker last week in Hong Kong that his frontline staff are not yet comfortable talking about RFRs and the myriad of issues around and related to RFRs. So clearly banks have some training to do. The next slide, please. So the ARC's timetable in its recommended best practice for completing transition requires hardwired fallbacks based on SOFR to be incorporated into documentation by not later than 30th September. And a target cessation date for new dollar LIBOR deals of 30th of June, 2021. The ARC's deadlines are obviously targeted at lenders and borrowers in the States, but they will affect us all, including us here in APAC. And my question is, are market players listening, and will they be prepared in time? Then, as Arthur's already mentioned, a few weeks ago, the Hong Kong Monetary Authority issued its directive to AIs in Hong Kong in respect of transition milestones, talking about milestones that AIs should strive to achieve. So they're not hard-coded, with a view to setting a date after which US dollar deals should no longer be priced off LIBOR. I believe, and Arthur didn't actually say it, the theory here is that other regulatory bodies around APAC will hopefully follow suit with a sort of cascade effect. But there are a few things that bother me. The regulators are very keen for market practitioners, borrowers, and lenders to examine their portfolios, to set up new systems, transition their legacy portfolios, resolve any accounting and tax difficulties, and only use the overnight benchmarks going forward. My question then is, how much are the regulators really helping? Will the loan markets in Asia be ready? Your guess is as good as mine. The next slide, please. So what do we need to do to accelerate the process? And these are my thoughts, and hopefully APMA's thoughts. Ideally, we need IOSCO compliant forward-looking term rates, but failing that, we don't know whether we're going to get them or not. There are a few things I think we can do to accelerate transition. First of all, we desperately need consensus on calculation methodology. We can't have a division between the US and the rest of the world. Who's right and who's wrong? Secondly, both lenders and borrowers are going to need to invest a lot of money in operating systems, which of course they're not going to do until number one is sorted out. I think we need more pilot deals to test market consensus on structural issues, and we need a lot more focus on legacy deals, preferably with some quick fixes. And I point to the LMA's benchmark selection agreement as a good start. As I've said before, I think greater involvement and guidance from the regulators would also help. And forgive me if this is a bit racy, but I don't mean in launching surveys. I mean in taking the lead and guiding the market on some really tricky issues that have been around, as I mentioned, for more than 50 years. I'll add two more to the list that's in front of you. I think, as Rebecca was saying, we need some dedicated market education and awareness around the APAC region. And I think we also need more interaction with the US. And again, I think it was Rebecca who said the other day, the time difference is not helpful when the ARC or ASIFMA, not ASIFMA, apologies, when the ARC or LSTA does a webinar in the middle of their afternoon that's not available in Asia. With that, I'll wrap up. I've probably overrun my time, but that's where I think we are in the loan markets at the moment. Thanks, Rebecca.
You're on mute. Yeah.
Sorry. Thank you, Andrew. And I'll just follow up on the last point you made by emphasizing that the ARC now has replays of its webinars so that we can watch them during Asian time. Something. Now let's welcome Jing Gu, who's the head of legal for Asia Pacific at ISDA, and she'll share her insights on implementation of fallbacks and derivative contracts. Jing, over to you.
Thank you, Rebecca. So in the next 15 minutes, I will walk through the implementation of contractual fallbacks for derivative contracts. Next slide, please. 350 trillion in various financial instruments reference LIBOR, which is expected to cease after the end of 2021 and may be followed by the cessation of other IBORs. Among the outstanding financial instrument reference LIBOR, the majority is financial derivative transactions. As Mr. Arthur Yang mentioned in his opening remarks, the difficulty in amending legacy trades has been identified as one of the biggest barriers for LIBOR transition. In this respect, we have some very good news to announce. ISDA has been working on contractual fallback language for derivative transactions by amending its standard definition booklet. And we're planning to launch the ISDA protocol and ISDA IBOR fallback supplement very soon. The documentation will be final by end of July. So I will start by discussing why are changes to fallbacks necessary. 2006 is the definitions that generally incorporate by reference to confirmations for uncleared interest rate derivatives, and the rule books of CCPs that clear interest rate derivatives. Current fallbacks under 2006 is the definitions typically require the counterparty, that is a calculation agent, to obtain quotes from major dealers in the relevant interdealer market. If an IBOR has been permanently discontinued, it's likely the major dealers would be unwilling or unable to give such quotes. It's also likely that quotes could change materially across the market. So what risk has been chosen as fallbacks for the IBOR? It was determined that the fallbacks will be adjusted versions of the risk-free rates, IFRs identified by public and private sector working groups in each jurisdiction as alternatives to the IBOR. So this slide summarizes the IFRs identified in the LIBOR jurisdictions. Next slide, please. Next slide, please. Oh, can you go back to the previous slide? Thank you. ISTA's fallback documents will cover 13 floating rate options. ISTA has selected Bloomberg as official adjustment services vendor to calculate those IBOR fallbacks. 11 fallback rates will be published by Bloomberg for each IBOR and specific tenor. SOAR fallback rate will be published by ABS, administrator of Singapore swap offer rate, and Thai baht fixed fallback rate will be published by Bank of Thailand, which is the administrator of Thai baht fix. Next slide. A number of key Asian benchmarks are FX swap implied benchmarks. For example, SOAR used in Singapore represents the effective cost of borrowing Sing dollar synthetically by borrowing US dollar for the same maturity and swap out US dollar in return for the Sing dollar, and is calculated based on actual transactions in the US SGD, FX swap market, and US dollar LIBOR. So when US dollar LIBOR is no longer available after the end of 2021, the future of the FX swap implied benchmark is in doubt. Those key benchmarks include SOAR in Singapore, Thai baht fix, MY4, and the reference bank rate in the Philippines. So Singapore, Thailand, India have set up their respective national working group to look at local benchmark transition issues. In Singapore, the Association of Banks in Singapore and Singapore FX Market Committee have identified the Singapore overnight rate average SORA as alternative risk-free rate and have set out a roadmap for this transition. SORA is administered by MAS and is an interest rate benchmark based on the average rate of unsecured overnight interbank Sing dollar transactions brokered in Singapore. For new SGD interest rate derivatives, the steering committee for SORA transition has recommended use of SORA. And for legacy trades, after conducting thorough review, the committee has decided adjusted SOR is the most appropriate fallback rate for legacy SOR contracts. ABS will calculate adjusted SOR by replacing US dollar LIBOR with its fallback rate published by Bloomberg, which is SOFR compounded in arrears plus the credit spread adjustment when dollar LIBOR discontinues or ceases to be representative of the economic reality. ABS will publish its methodology for SOR fallback rate on its website. Thailand has adopted a similar approach after public consultation conducted by the Bank of Thailand early this year. BOT has recommended legacy Thai baht fixed derivative contracts will fall back on adjusted Thai baht fix, which means dollar LIBOR will be replaced with its fallback rate in a similar way as what's going to happen to SOR in the current formula when US dollar LIBOR discontinues. And the new derivative contracts referencing Thai baht fix will move to a new RFR called THOR, Thai Overnight Repos Rate, which BOT started to publish in April. ISTA has added the new rate to its 2006 definitions. For cash products referencing Thai baht fix, the committee chair BOT expects to provide suggestions or guidelines within the second half of this year. As to MIFO, there is a national working group chaired by Indian Banker Associations, and they're expected to make a recommendation about the MIFO transition and fallback issue in Q1 next year. Next slide. Okay, so now I will take a few minutes to talk about the major changes which will be introduced in the ISTA IBOR supplement and protocol. As I mentioned previously, ISTA aims to amend Section 7.1 on floating rate options in the 2006 ISTA definitions for relevant IBORs. ISTA has consulted on by publishing a supplement to implement fallbacks for new contracts referencing those IBORs. The amended floating rate options will generally include the existing price sales information, a statement identifying objective triggers for permanent cessation or pre-cessation for LIBOR currencies, and a description of the fallback that would apply upon the occurrence of that trigger, which will be the adjusted IFRs plus the credit spread adjustment. Upon the effective date of the supplement amending the relevant floating rate options, all new derivative transactions that incorporate the 2006 ISTA definitions will include the fallbacks. In other words, counterparties will not have to take any additional steps. Next slide. What about the legacy trades which were entered into prior to the publication date of the ISTA supplement? So those transactions will be amended by ISTA protocol. To address the legacy contract issue, ISTA is also planning to publish a protocol to facilitate multilateral amendments to incorporate the fallbacks in legacy transactions. By adhering to the protocol, market participants would agree that their legacy trades with other adherents will include amended floating rate options for the relevant IBOR and will therefore include a fallback. As always, any such protocol will be completed. As always, any such protocol will be voluntary and will amend contracts only between two parties, both of which have adhered to the protocol. The fallbacks included in legacy contracts by adherence to the protocol will be exactly the same as the fallbacks included in new transactions that incorporate the 2006 ISTA definitions. So what contracts will be covered under the protocol? The protocol will cover the ISTA master agreements, ISTA credit support documents, and confirmations that incorporate one of the several ISTA definition booklet, including 2006 and 2002 and the early version of the interest rate definitions. It will also cover any of the documents I've just mentioned which reference an IBOR as defined in and has a meaning in one of the several ISTA definition booklets, or reference an IBOR however defined. The protocol will also extend to certain non-ISTA master agreements and credit support documents and confirmations. The list of non-ISTA documents are under discussion in the ISTA working groups and are subject to confirmation. One thing I want to highlight is that the ISTA protocol does not cover any cleared derivative trades. Clearinghouses have indicated they will use the powers in their rulebooks to implement the fallbacks in all of their legacy cleared derivative transactions as of the effective date of the updates. Next slides. The fallback apply upon the permanent discontinuation of the relevant IBOR, and will be the fallback will be to the relevant IFR I've just mentioned. The permanent discontinuation trigger is defined as index cessation event in the non-LIBOR rate options, such as CDOR, BBSW, HIBOR, and TIBOR. The fallbacks will not apply until the actual discontinuation of the relevant IBOR. If that's after the announcement date, the date is defined as index cessation effective date. So give you example, if FCA make announcement in Jan 2021, saying LIBOR will cease to be published in 3 months' time in April, the fallbacks will only kick in April when the index cessation effective date occurs. For LIBOR rate options, which include the 5 LIBOR currencies and SOR and Thai baht fix, the fallbacks apply upon the earlier to occur of the permanent discontinuation or the non-representativeness as determined by the UK FCA. This is referred to as a pre-cessation trigger in the relevant currency, and will be to the relevant alternative IFR subject to term and spread adjustment. So the index cessation effective date for the pre-cessation trigger would be the date on which LIBOR in the relevant currency is no longer representative, which may either coincide with or be after the date of announcement that is no longer capable of being representative. ISTA has conducted 2 consultations on the pre-cessation issue, and the conclusions are published on the ISTA website. One thing I want to highlight for SOR and Thai baht fix is that, as I mentioned, because the current formula use dollar LIBOR as the input, for SOR and Thai baht fix, the index cessation event is defined by reference to US dollar LIBOR. Therefore, a statement regarding permanent cessation made by the LIBOR administrator IBA or its regulator FCA in relation to US dollar LIBOR will trigger the application of the fallback rate for SOR and Thai baht fix as well. The second issue to highlight is that the pre-cessation trigger is applicable to SOR and Thai baht fix as well. This means when FCA makes an announcement about US dollar LIBOR being non-representative of economic reality, that would trigger the fallback for the 2 Asian benchmarks. Next slide. Okay, Andrew has already mentioned why it's necessary to have term and spread adjustment. As Andrew has mentioned, the ISTA methodology, which was chosen by market participants after a few consultations, is based on compounded setting arrears rate and a 5-year historic media approach to the spread adjustment. The compounded setting arrears rate is RFR observed over a period and compounded daily. The rate adjusted whereby the observation period is backward shifted to allow for the date to be known prior to the relevant payment date. So the fallback rate would be the rate you will look for on Bloomberg website 2 days prior to the payment date. The 5-year historic median approach to the spread adjustment is based on the median spot spread between the IBOR and the term adjusted IFR calculated over a static look-back period of 5 years prior to the index cessation event. The spread adjustment will be added to the compounded setting arrears rate, but will not be compounded itself. Next slide. Bloomberg will publish 3 numbers on its dedicated screen page. One is compounded setting arrears rate, the second is the spread adjustment, and third is all-in fallback rate on a daily basis. For the 11 floating rate options, the fallback, as I mentioned, the fallback rate for SOR will be published by ABS, and the fallback rate for Thai baht fix will be published by Bank of Thailand. The publication will be on an indicative basis, that is, as if the fallbacks were triggered on the publication date. So upon the occurrence of an index cessation event for the relevant IBOR, the spread adjustment will be fixed. Contracts will continue to reference the relevant IBORs until the index cessation effective occurs. Upon the occurrence of index cessation effective date for the relevant IBOR, the IBOR contracts will reference the all-in fallback rate, which will include the spread adjustment that was set on the date of index cessation event, but with a changing compounded setting arrears rate. Next slide. The key dates. So Bloomberg started the publication of the indicative fallback rates for the 11 floating rate options last Friday on July 17. The IST IBOR supplement and fallback protocol will be final by end of July, and we will launch the documents after receive positive business review letter from the US Department of Justice and similar comfort from other relevant competition law authorities. IST will provide market participants with around 2 weeks notice of the official launch date and later effective date. So the documents, when it's launched, will not be coming to effect immediately. It will be effective around 4 months after the publication date, which is we refer as the launch date. During this 2 weeks period, IST expects to facilitate a process whereby regulated entities and other key market participants can adhere to the IST IBOR protocol in escrow prior to the launch date. IST is planning to reach out to the national RFR working groups and also the FSB OSG regarding the adherence in escrow procedures. Next slide. Just one more word to mention regarding the protocol. If you are planning to adhere to the IST protocol, you could go to the IST website, and under the section of protocols, you will be able to find the information on the protocol and also FAQs and the relevant title. IST is also planning to publish local Asian language translation to facilitate the understanding of the IST fallback documents. We're likely to publish a Chinese version, a Korean version, Indonesia Bahasa version, and also Japanese version. In the APAC region, regulators and some regulators, central banks in some jurisdictions, for example, Japan, New Zealand, South Korea, have encouraged the regulated entities to adopt IST fallback language for LIBOR contracts. We plan to continue our education outreach by working with central banks and the trade associations in this region about IST IBOR fallback documentation. There will be a number of other templates we will publish, which includes a short form bilateral amendment agreement to incorporate the terms of the protocol and also a long form amendment agreement. There will also be template language for excluding agreements, transactions from the amendments made by the attachment to the IST IBOR protocol and agreeing to a bespoke fallback instead. So I won't go into too much details about the other templates. Next slide. For the central cleared trade, there's some other changes which is also happening this year. This is a change of the discounting rate. For Euro, the change will happen on July 24. And for US dollar denominated trades, the switch will happen from on 16 October 2020. So CCP is planning to switch the discounting rate from the Fed funds to SOFR. In terms of the bilateral trades, IST has published a bilateral template IONIA amendment agreement, which parties can use to amend legacy trades or existing collateral agreements so that they reference Euro STR instead of IONIA. We will also publish a template to facilitate change of discounting rate in a bilateral CSA from Fed fund to SOFR if parties intend to ally their centrally cleared trades with non-centrally cleared trades. Next slide. One thing to mention is that ISTA has also published a collateral agreements interest rate definitions. The two templates regarding discounting rate change reference to the definitions included in this document. Next slide. ISTA, together with other trade associations, published a global benchmark transition report in 2018. And Rebecca has also mentioned we recently published a simpler one for the Asian market participants, together with other trade associations. One thing to mention is that the fallbacks I've just mentioned are not intended to be a primary means of moving from IBOR to IFRs. Once the fallbacks are in place, it's recommended that market participants focus on voluntary transition before the cessation of any key IBOR, moving away from key IBORs voluntarily by amending or closing out contracts that reference those rates allows counterparties to tailor their strategies to their specific portfolios and could allow firms to negotiate terms that avoid adjustment mechanism for fallbacks. The Alternative Reference Rate Committee, ARC, in the US identified 9 possible models of conversion that market participants may use when voluntarily transitioning derivatives transactions that reference IBORs to IFRs. Next slide. So I will conclude my my talk today by saying, wait for ISTA notification about the launch date of the IBOR documents, which will be happening very soon, and use those documents to amend your legacy derivative contracts. We have also published a number of documents on our website regarding the coming documents and also the adjustment methodology, and you could have found the relevant information on our website. That will be the end of my talk. Thank you.
Thank you, Jing. Now let's turn it over to Mushtaq Kapasi of ICMA to share with us the implications of IBOR transition on the bond markets here in Asia.
Thank you and welcome everyone who's on this webinar. Thank you very much to ASIFMA as well for giving me the chance to share some views from ICMA, where we are focused on the bond market and the benchmark issues around that. Now, first of all, ICMA's view is that the market should prepare for a cessation of LIBOR after 2021. This is the same view of the regulatory authorities around the world, and the regulatory authorities have been clear that the target date will not be postponed due to the pandemic. The official sector has consistently stated that the best way to minimize the LIBOR transition risks, particularly in the bond market, is simply not to issue new bonds linked to LIBOR. In other words, to issue bonds linked to the risk-free rates. In the US dollar floating rate note market, we've seen significant new issuance directly linked to SOFR, more than $300 billion US dollars. However, even today, we are still in parallel seeing new issuance in US dollar LIBOR across international markets, including Asia. On the other hand, in the somewhat smaller UK sterling cash bond market, the story is a bit different. New public issues of FRNs referencing sterling LIBOR maturing beyond the end of 2021 have all but ceased for several months now, and new bonds are issued using SONIA. For both SOFR and SONIA, the Federal Reserve and the Bank of England are each making available an index which is expected to facilitate adoption of these new rates, at least in the bond markets, by making it easier to calculate compounded SOFR and SONIA rates over any period of time. Next slide, please. Now, if the issuance of LIBOR-linked bonds is unavoidable, then we strongly recommend to use robust fallbacks to risk-free rates. For the US dollar LIBOR market, as mentioned previously, last year the ARRC produced fallback language for new US dollar LIBOR FRN contracts. Note, this is applicable only to new US dollar denominated floating rate notes. But the US authorities have also said that as good as the fallback language may be, simply relying on fallback language to transition still gives rise to a number of operational risks and economic risks. And so the recommendation is that market participants should be moving to referencing alternative rates such as SOFR. In the European market, documentation is a little bit different. We've generally seen more quote unquote currency and benchmark agnostic fallbacks. What this means is that the fallback language does not talk about a specific new risk-free rate, but it rather gives a procedure for selecting an alternative rate, plus an applicable spread. And this would be based on recommendations made by relevant official bodies, usually run by some sort of an agent or administrator. The language is fairly standardized as a matter of market practice for fallbacks now. And given the move away from LIBOR issuance and towards issuance of bonds referencing alternative rates such as SOFR, the market consensus, at least today, is that it's not a priority to publish standard fallback language now for non-US dollar LIBOR. I should emphasize, of course, that any new fallback language will apply to new issuances of FRNs only. It will not have any impact on bonds already in issue. Next slide. So if we take the pool of outstanding LIBOR-linked bonds, it's helpful, at least for me, to divide this into three categories, or three buckets. The first bucket is those maturing before the end of 2021. So if the bonds are maturing before the end of 2021, we don't have to worry about these as they will not be affected by the cessation timeline. The second category is new LIBOR-linked bonds issued from around mid-2017 when the market became aware that LIBOR would end. These typically, but not always, include fallbacks designed to operate so that the bond starts to reference a risk-free rate, as I've just described, and so are not considered to be as problematic because they already have fallbacks in them. Now, the third category is the most tricky. These are legacy bonds referencing LIBOR, which mature beyond 2021 and do not have fallbacks to another risk-free rate. The situation is similar in the loan markets. So when it comes to this third category, now usually called quote unquote tough legacy bonds, how big is the problem? Market estimates have indicated that legacy bonds referencing LIBOR due to mature beyond the end of 2021 are at least $800 billion US globally. Most of this, around 80%, is denominated in US dollars, with the rest in sterling and other currencies. Now, according to Bloomberg, thanks very much to Bloomberg for providing data as of last week, US dollar 82 billion of Asian LIBOR-linked notes issued by corporates and FIs are maturing from 2022 onward across 327 issues. And this compares to about 200 billion of Asian LIBOR-linked syndicated loans, as Andrew has mentioned before, maturing from 2022 onwards. So most of these legacy bonds that are maturing beyond 2021, what will happen to them? They'll fall back to a fixed rate when LIBOR is permanently discontinued. And obviously this gives rise to potential commercial and even litigation risks, since the fixed rate would not reflect the commercial intention of the parties when they entered into a floating rate transaction. Next slide, please. So we've heard about loans, we've heard about derivatives, but publicly issued bonds pose different issues simply because they are not bilateral or syndicated to a small group. They are, in terms of process, unfortunately much more difficult to amend, and they cannot be amended through an industry protocol. Mr. Yoon from HKMA alluded to this in the survey, where the contractual changes is actually one of the biggest obstacles perceived by the market in the transition from LIBOR. So one way of addressing the legacy LIBOR bond problem is to amend the interest rate provisions in bond contracts through consent solicitation. But this is not easy in practice. Individual bonds are often held by many investors, and consent thresholds to amend the interest rate provisions are generally high. Actually, they can be 100% in the US, making it almost impossible to amend the bonds by consent. Trying to use consent solicitations to transition the whole of the legacy bond market, including FRNs, covered bonds, capital securities, securitizations, would be a very long and complex process and may not be successful. Next slide, please. So far in the UK market, we've had 19 consent solicitations completed, including both financial and corporate issuers. Each of these transactions has been undertaken on the same basis, amending LIBOR to SONIA compounded in arrear plus a spread. I won't go into details here given the time limitations, but if you have any questions, please reach out to us and we can tell you more about the specifics of these transactions and the fallback rates. Next slide, please. Now, with respect to tough legacy, the regulators are aware of this problem. And I'll just say very briefly that the British authorities, the official sector, FCA and Bank of England, have made announcements that they intend to promote legislation that would in effect allow a change of methodology for LIBOR, even across currencies and tenors, if doing so would protect consumers and market integrity. In other words, the upshot here is that there may be a potential legislative solution, at least in the UK, that will involve changing the methodology of LIBOR, but this is by no means certain. And at least the Bank of England has said that the best solution is still to transition away from LIBOR. Next slide, please. Now in the US, there's also a legislative proposal, which is already a bit more fleshed out in terms of details, proposed by the ARRC. And basically what this would do is it would allow more easily for contracts to be amended to transition to LIBOR, and it would give a number of safe harbors, both for the parties and for the benchmark agent, to protect them if the rate changed by force of law. Again, details about this are in the ARRC publications. We'd be happy to talk you through this as well, but I won't go into details on this webinar. Next slide, please. One other option for bond issuers, if a consent solicitation will not work to amend the bonds, is buying back the bonds by way of a tender offer or open market repurchase, or issuing new bonds, reissuing new bonds in exchange for the legacy bonds by way of an exchange offer. But unfortunately, these are also likely to add additional layers of complexity and would give rise to a different set of market and commercial tensions. Of course, the final option, if we've exhausted all other possibilities, is simply to let the bonds operate according to their existing contractual terms. And in this case, the bonds would revert to fixed rate, even if this was never the issuer's or investor's intention. So in closing, I'd like to mention briefly that there are other risks related to the transition from LIBOR in the bond markets. And these have already been mentioned by Mr. Yoon of HKMA. Risks of hedging mismatches, recharacterization risks of capital instruments, tax events and unfavorable accounting implications, and potential mis-selling or conduct risk, among others. I'd also just refer you all to the guide to Asia benchmark transition that was put together by ASIFMA and the trade associations. This is actually very helpful in identifying some of these risks. We at ICMA can very happy to give general guidance on these, although we cannot offer legal advice. And I can also mention that ICMA has a risk-free rate transition from LIBOR webpage, where we have a number of resources from ICMA, the official sector, and other trade bodies on the bond markets and the effect of transition from LIBOR. Finally, just to mention that last month, we also held a virtual official sector panel, which included senior representatives from the UK FCA, the Federal Reserve Bank of New York, the European Central Bank, and the Swiss National Bank, along with the European Investment Bank. This is a very good summary of the official sector view on benchmark transition to complement the very good speech of Mr. Yoon, and you can get a recording of this panel free of charge for everybody on the ICMA website. Thank you very much for your time and attention.
Thank you, Mashak. Now, I would like to turn the presentation over to Dennis To, Regulatory Specialist, Enterprise Solutions, APAC of Bloomberg, to share with us practical challenges of LIBOR transition. Before I do, I just want to apologize that we are overrunning. And if we don't get to Q&A, please send your questions anyway, because I will try and prepare a FAQ sheet using the questions that are submitted during the panelists' presentations, and I will distribute the answers to the FAQ to all of those who are attending. So please continue to shoot in your questions. And again, I apologize for the delay. Dennis, over to you.
Thank you, Rebecca. Good morning or good afternoon, everyone. And on behalf of Bloomberg, we thank ASIFMA for giving us the opportunity to share with you all a quick update on LIBOR transitions. We heard from the earlier sessions industry experts on their comments and challenges on handling transitions in their respective asset classes. So to complement this, we, Bloomberg, as a data or technology solution provider, would like to share some practical challenges that our customers have raised to us and some of the issues that we have proposed to our clients in order to consider their readiness on the LIBOR transitions. Next slide, please. So the benchmark transition process impacts multiple work streams simultaneously. We advise our customers to adopt a holistic approach in assessing the impacts of transitions in order to identify gaps in their existing system infrastructure, requirements for new data sets, as well as quantifying the impacts from a valuation perspective. We suggest our customers to consider the impacts of LIBOR transitions through 8 different work streams. So this slide you will see is the first 4 work streams that we have identified. The first focuses on impact on front office trading. So this is all about whether your front office can handle trading of new instruments referencing to the new risk-free rates, as well as explaining the economic impacts to both yourselves, internally, and also to your customers. The second work stream focuses on operation side of things. It's more like, can your system handle daily compounding interests, calculating cash flows, or evaluate the impacts of the PAIR process for your IRS trades independently? The third focuses on contracts. You have to identify all LIBOR-linked exposures that matures beyond 2021, for example, ascertain what fallback provisions are actually written in the contracts, and possible legal ramifications in order to renegotiate your legacy contracts. The fourth area focuses on regulatory compliance. Are you ready to time your internal transition plan to match the timeline set up by regulators? For example, looking at the new recommended guidelines released by the HKMA just a few weeks ago, such as like inclusion of hardwired fallback provisions, cease referencing to LIBOR for new trades, etc. Next slide, please. So here are 4 additional work streams that we have identified. The fifth focuses on treasury and the funding business, as inadvertently you will need to switch the basis of your short-term funding and hedging to the new risk-free rates. The next area, which is also the area most of our customers are struggling with at the moment, is in terms of valuations and market risks. As we switch from a LIBOR discounting to the new risk-free rate discounting regime, which typically based on an overnight interest rates, you need to ensure that your systems can handle the pricing and calculations of risk exposures under both discounting bases. This is particularly challenging if, on one hand, it takes time for you to implement upgrades to your existing systems, while at the same time, you're pressed for time to actually attribute the valuation impacts due to the changes of discounting basis in the interim. The last 2 areas focuses on accounting, finance, and IT infrastructure. Once you have identified the valuation impact, you will need to consider the downstream impacts. That is, if your other system, aforementioned, can actually handle the outputs from your pricing systems, given that they are all calculated in different interest rate bases. As a solution provider, Bloomberg focuses more on the data and the analytical piece of LIBOR transition process, where we develop our system architecture as consensus on market conventions converges. In the next few minutes, I will quickly share with you some additional comments on these 2 fronts. Next slide, please. We can first focus more on the data requirements. The most common questions that our clients had raised at the early stage of the LIBOR transition project is what new data sets would they need to acquire? As Jing has mentioned, as of this week, Bloomberg has begun publishing the official Easter IBOR fallback rates. So if you haven't taken a look yet, do references to this link or FBA Keiko on the Bloomberg terminal to see what these rates are about. As you begin engaging in new trades referencing the new risk-free rates, you also need to make sure that from a reference data perspective, you can capture all necessary attributes that references to new risk-free rates. So things like compounding conventions, observation period, etc. This is just to make sure that at the baseline, your frontline prices can actually properly evaluate these new trades based on these new risk-free rate terms. Next slide, please. The next question surrounds the necessity of identifying fallback languages, in particular for cash-based securities, given that there is less standardizations compared to the derivatives markets. For any legacy trades, you need to begin your assessment by identifying the exact fallback provisions that has written, say in the bond's original prospectus, determine the practicality of such fallbacks, and focus on those provisions that are susceptible to further review in the future because they are deemed inoperable. When you're dealing with a large inventory of legacy trades, it will be impossible to eyeball and identify these provisions manually. Instead, you need to look for a solution that enables a more systematic scanning of such provisions in an automatic fashion. It is actually quite important to proactively monitor possible changes to these fallback provisions by, for example, observing how other similar issuance adopts or changes their provisions, so that you are in a better position to analyze when whatever new fallback provisions is being proposed, you'll be able to quickly determine whether they are practical and acceptable to you. Next slide, please. A lot of our customers had also begun asking the questions of how to construct interest rate curves that references to the new risk-free rates. As the market continues to evolve and liquidity begins to emerge, the best practice to construct this risk-free rate curves will also change. Therefore, when evaluating whether your system is ready to take on these new risk-free rates-based curves, you need to ensure that it is flexible enough to respond to changes in markets. In particular, flexible to take in new market data and pricing quotes as they continue to emerge in the markets. From Bloomberg's perspective, we currently construct our curves using US dollar SOFR curve as an example, SOFR futures, plus a blend of SOFR basis quotes that represents market liquidity to the best extent that we can. We are also constantly sourcing additional liquidity providers and will incorporate these in our curve building methodology as time goes by. Next slide, please. Once we have identified or fulfilled the data gap, we need to next consider the analytical and evaluation piece of the LIBOR transition project. Our customers have very commonly shared with us that in order to gain traction internally and move forward with certain LIBOR transition projects and budget approval, they actually need to quantify the impact on the valuation side of things to their internal stakeholders and senior management. Given that it takes time to upgrade their existing systems, they need to find a quick and easy interim solutions that allows them to explain the transition impacts. Equally important is that such interim solutions should allow customers to run various LIBOR cessation scenarios and timeline, as well as contingency plan in place for running the same analysis for an expanded product scope. We talked about IRS quite extensively previously, but you might also need to start looking into other products such as interest rate derivatives, options, cross-currency swaps, loans, or even structured products in the future. So this is something a solution provider such as Bloomberg might help, as we could allow our customers to adopt a low technology footprint solution as an interim without disrupting the actual work they needed to be involved in upgrading their core systems. Next slide, please. So for non-cleared trades, Jane actually also made a point earlier as well. Aside from relying on fallbacks, market participants would also have the option to renegotiate, or what we call repaper, their existing trades on a voluntary basis. This actually helps market participants to tailor-make their transition strategy based on the portfolio's exposures and the actual requirements. It is therefore crucial for market participants to fund-run these repapering assessment by setting up various pricing scenarios or possible repapering terms before the actual negotiation takes place. As such, market participants will again require an interim solutions in place so they can run quantitative analysis on possible repapering scenarios as early as possible. Some use cases here, banks could, for example, utilize such tools to provide some transparency on their repapering strategies to their customers, while end users, on the other end, can independently verify the proposed repapering terms and can make informed decisions in a timely fashion on whether they wanted to accept these repapering terms or not. So that pretty much concludes what Bloomberg wanted to share with you all today. Thank you all for listening. Do stay safe and do reach out if you have any additional questions. Back to you, Rebecca.
Rebecca, you're on mute.
Thank you. Thank you, Dennis. I appreciated that. I'm sure our viewers got a good understanding of some of the solutions that they can look into to solve some of these data problems. Now I'm going to turn over to Q&A, and I would encourage the audience to continue to use this function. We're going to try and publish an FAQ based on the questions that come into us after this session so that all the questions can get answered. But we will run till noon, which I know is an overrun. So again, apologies, but we'll do the best we can to get in a few questions now. The first question is over to Jing. Has there been any development in the Korean benchmark regulation and an English translation of this act?
Yeah, I don't think, I'm probably gonna take this question offline. I don't think that's relating to the LIBOR transition topic today. I think that's actually something similar, but in a much smaller scale, something equivalent to the EU benchmark regulation. I think Korean is also trying to get equivalence under EU BMR, but as I mentioned, this is a completely separate issue. So whoever raised that question, please reach out to ISTA separately.
Jing, we got a very similar question relating to EBA in India, and I want to make sure that the rest of Asia gets an opportunity to ask questions. So I'll let you answer that one as well.
Which question? Sorry.
About India. A similar question on India.
About Indian benchmark regulation.
Yeah.
Yeah. Again, I would take that. So the IBA Indian Banker Association initiative, that's for the LIBOR transition. The Indian benchmark regulation is a separate issue. So it's essentially a regime which is meant to regulate certain key benchmarks regulated by RBI. And we've seen that in other APAC jurisdictions, Australia and Singapore in the past few years, which also introduced benchmark regulation. So again, that's a separate issue from LIBOR transition, which we covered earlier today.
Will there be any recommendations, Jing, on how to choose conventions for different products?
Yeah, for that question, I think I probably will also need my co-speakers, Mushtaq and Andrew, to answer. I think as far as derivatives are concerned, ISTA has done a number of market consultation. The methodology, this compounded setting areas, and the spread adjustment have been decided, and Bloomberg started publishing indicative rate, fallback rate. So I think either market participants will adopt is the fallback rate, or alternatively, they might be looking at some other fallback. I think a question which is likely to arise is if you're using the swaps to hedge particularly a specific loan or bonds, you possibly would want your fallback language to lie with your cash instrument. So I think that's where you would have the issue about which convention you should be choosing. But again, I think that's something everyone will need to watch the space, in particular, any development in the loan space, as Andrew mentioned.
Mushtaq or Andrew, do you want to add on to that, or from your product's perspective?
Sure, unless Andrew wants to go ahead. I can just mention very briefly that there are no directives necessarily from ICMA, but in terms of bond fallback language, if you are still issuing new bonds under LIBOR, there is the ARC language for US dollar LIBOR, and then there's fairly market standard language for kind of non-US or EMTN program type bonds. But our overall recommendation is to issue new bonds under the new risk-free rates. So that would, I hope, obviate some of the issues about what the actual fallbacks are. I don't know if that answers the question adequately. But.
Andrew, do you want to add to that?
Yeah, just one point. I think that we are going to end up in a situation where We've got the swaps and derivatives markets following some conventions and the loan and bond markets following others, and there is going to be a basis risk. I don't think it's actually possible for everybody to get on the same page on everything, on every product. There's going to be fragmentation between product and then possibly between geographies. So there is going to be basis risk. There's opportunity always. When there's risk, there's opportunity for swaps desks to cover that basis risk. But I think it would be too optimistic to say that, oh, well, look, you know, we're going to align every convention to the ISDA swap market. It just wouldn't work. Maybe I've answered the wrong question there.
I think that was very helpful. The next question is something I haven't thought about, but I'll see. So I'm curious to see your answers. Somebody asked whether digital currencies will have any impact on IBOR transition. Does anybody have any views on that?
Pass.
I don't have any particular views on that, to be honest. I haven't seen that as being.
They're kind of beyond IBOR transition, but you know, Dennis, do you have any thinking on that?
No, I haven't came across any questions coming in for digital currencies at this stage. It might, but not at the moment from our end.
Yeah, if I may go off piste, I think that first of all, given the transition from LIBOR should be at the end of next year, although you know it may kind of lurk past that, and most plans for digital currencies are still in fairly early stages, I would say. So even from a timing point of view, it's not necessarily directly related, but just from a purely kind of theoretical point of view, the issues that we've all outlined with respect to transition seem independent from the actual currency being used or the form of the currency.
Okay, I think that's about all the time we have. I want to thank our panelists and of course the audience for attending, and I'm going to turn it over to Millie from ASIFMA to close the session.
Thank you, Rebecca, and thank you everyone for being with us today. We'll be sending you an email within the next couple of days, which contains the link to view the video of the recording of the session, as well as an FAQ sheet that covers the questions we received today but didn't have a chance to answer live. Please feel free to share them with your contacts. We'll have more virtual events coming up. Please visit our website, www.asifma.org/events, or watch out for our emails. Have a good day. Thank you.